Welcome back. Today we're going to talk about variance analysis. And I'm very excited to introduce this topic because actually this is something very much managerial accounting analytical fast way of company been doing for years to try to understand if what they're expecting to use in a production versus what they're buying things at, and it combines together procurement cycle, engineering, design of the product. For this chapter right away, I'm going to let you know this. We're just going to do material and labor variance analysis. We will not be doing overhead analysis for sake of a learning experience for this class. However, it's in your chapter. So if you want to address this, please do so. Usually, overhead variance analysis are tightly related to labor hours, so they are very similar to it. So this is why we don't cover this. But that's something I want to mention. If you do want to know more about it, you're obviously welcome to explore on your own. All right, I'm ready to start sharing with you. And at the end of this presentation, I'm also going to go through example in addition to one that I'm doing during the presentation, so we have more opportunities to practice. All right, so standard costing and variances. So companies in the beginning of a year or every 5 years, whatever time they choose, they would have a certain standard number they would have in mind. They're thinking they should be spending on a product, how much material they should be using. We all do this day to day. You know, when you go to a store, you have a certain number you're thinking gallon of milk should cost or gallon of gas should cost, right? So we numbers do fluctuate, but if you walk in a store and gallon of milk costs $8, you know it's probably a little bit pricey, right? Even if it's organic milk. So we do have a preconceived notion what things should be. Well, companies do the same, except obviously they'll have a lot of prices for different products. Now, a little bit of vocabulary. If you're not a manufacturing person, BOM, bill of material, would have a lot of little items in there. So we're going to just look at one material price, but companies would have reports and reports per item what the standard should be. So without further ado, let me give you some definitions, and then I'll step back and give you a couple examples how it would apply in real life. So price standards, specifically, how much should we pay for each unit of input? What is the normal price to spend for that? So if I tell you this calculator, for example, cost me $50, you're going to say, you probably, Miss Labrizia, overpaid for this calculator. I would say the same. I did not pay, I think, $50 for it, but you say anywhere under $5 or $10 might be acceptable, right? So it depends what functions this calculator have. So we have a standard price you're expecting to pay for certain product. Now, I'm going to use an example. Since I work at school, we were designing one of the accounting labs, and I got involved because we wanted to make sure that's a space our students would like and find it welcoming and conducive to education, and we wanted that to structure it as a classroom environment. And later on, the pricing came in, which was, we had a budget, but there was money allocated by a different department. We realized how much money was chairs. And I was shocked because, you know, as a consumer, I buy a chair, and, you know, my office chair cost me somewhere under $100. And those chairs were $500. Uh, so, and I was explained that a normal standard price for school chair could be expensive because it has to carry certain weight of a student. It comes with certain insurance and liability because obviously we are bound by loss of disabilities and so on. So suddenly the chair that looks like $100 chair to me has this exuberant cost because it has certain weight that it can carry, including some liabilities that comes with that. So the standard price, what I think is standard, turns out to be very different price for that lab. So that was kind of shocking experience for me. So just because we think we know what it is, it could have other things built in it. Quantity variance. Love talking about this. And let's see how prepared I am. Not too prepared, but we're good. So I like to use a piece of paper. I've been dreaming of covering my face on the screen. Here I am. And let's say, what do we have here? Let's say I have my little LaCroix here. It always goes in my face-to-face lectures, but you guys get to see it. So let's say I want to cut up so many LaCroix can imprints on this sheet, right? So how many do you think we can do? 1, 2, 3, maybe 4, right? So let's say engineers, bright people, come up with a engineering design where one sheet of paper can cut up 4 cans. However, it turns out once it goes in production, they're able to cut only 3. Well, there's something wrong here. I'm using too many sheets. Let's say it's very expensive. Let's say it's, I don't know, gold or platinum, whatever the most expensive metal out there right now. So suddenly, me not utilizing a full sheet or aligning correctly becomes a production problem, right? So this is a quantity standard. How many sheets are we using? Then we have to see where the problem is. Did we buy a poor quality of a metal where we cannot arrange them close enough to the side? Do we have machines that our maintenance are poor and we cannot clip the sides of a metal sheets, right, to the side that the things can be cut out correctly? So those kind of things comes down to more production operational side. So what the variance does, it tries to figure out, did we spend too much or too little on a product, and separates the issue of quantity standards to be using material properly. Okay, so without further down, and then you know who to scream at, who to reprimand, who to negotiate better pricing with. So if you bought a worse product, you might be dealing with the production issues because your product not is good to be able to cut off 4 cans on one piece of paper. Okay, so standard price per unit, it's a final delivered cost net of discounts. Then discounts, shipping costs, freight costs, whatever it is. So that's what we call a standard price, what you're expecting to pay for this unit. So standard comes out maybe once a year, once a quarter, depends on the industry. Metal price has been changing drastically in the past couple of years, so maybe company would be changing standards more often. Now, standard quantity, we summarize it in the bills of material. How many units do we think should take to produce with a given material? How many pounds it takes to produce something? Another great example, think of a recipe. You're baking a cake, right? How many eggs does it take? How many cups of sugar? How much butter do you need? That's your standard quantity to have a final result. If you change the quantity, so each time I bake this cake and I put more eggs in it, then suddenly you're running out of eggs. So you're planning ahead, right? So you need to know what you need. So standard quantity, it's your recipe, what you think it should be. This also applies to direct labor hours. How long should it take to get this job done? So there's some kind of average. There's somebody timed this. I have some good stories to tell you. When the union was around, Case Corporation down in East Moline had old standards, how people were paid with the union regulations that were back from 1960s, and things got automated. So people were paid based on productivity. So do you change your standards based on machinery changing? So those things kind of need to be hopefully updated soon enough, or as soon as things are changing in production. But we actually had a standard that they had to abide by, and they couldn't change it for quite a while due to the labor laws on the state and the union at that time. So that was kind of interesting. But what is expected per rate of a product? And we're talking about product that is similar, homogeneous. So like it's something is the same. So if I'm a tax preparer, right, and I'm doing tax returns, every tax return is different. I can have a client come in with day trader with 1,000 transactions of gain and loss and stock sales. Obviously, just entering that data would take a while and reviewing it, versus somebody comes in with a simple tax return, maybe 2 kids, educational credit. So those 2 returns, one return might take 20 hours, another return might take 2 hours. We cannot say it's a standard time, but I can say an average single person without a household with 1 or 2 deductions might take 2 hours to prepare a tax return. That would be standard time that it takes to do the return. Okay, and what should be paid for this type of job? So you don't want to get somebody overqualified and overpay them, because then your product will cost more and people will not buy your product. You also don't want to get somebody who's underqualified and underpay them. So HR gets involved in that. Okay, so I do have stuff on overhead just to introduce it, but we're not going to do any calculation. So price standard, the rate of variable portion of predetermined overhead rate. So we're going to have overhead rate divided by hours, and that drives what you think your overhead should be per hour. And the quantity standard would be what it should take. But again, it's a lot of times based on labor. So this is why we're not covering here. All right, so this is what we have in our example. And this is something we're going to run with. So if you want to pause the video, pull out pen and pencil, and pen and pencil. You probably need a paper too, so pull that out too, and start writing and calculating along with me. I think that would help you to process this information. So this is what we know: standard quantity in hours to make a product for direct material. This is kind of just example of a standard cost card. 3 pounds, and we have $4 per pound. That would be a standard rate. So this is all standard. This is something we established. So standard cost per unit would be about $12. And you can hold off writing this down because our example has a different company. We're going to make Parker's. Okay, so then direct labor, we think it should take 2.5 hours. In this case, $14 per hour. So it's going to be $35 standard cost per unit. And variable manufacturing overhead, you guys can see it's relating directly to labor. And you're allocating $3 per hour. Therefore, your allocated manufacturing overhead is $7.50. So now your standard cost per unit is $54.50. Now you can price your product. You know exactly what to tell your customer you're willing to accept as a price for the product and so on. Obviously, now you're going to have to hold yourself up to that standard. Okay, so standard cost per unit for direct material, direct labor, and overhead can be used to compute activity and spending variance. So spending variance becomes more useful by breaking down into price and quantity. So spending variance, what you spent and what you should have spent. So it's a big number. But we're going to actually concentrate doing what is a problem is with a price or quantity. So overall variance is a spending variance. But spending variance consists of two variances, price and quantity variance. Okay. Price variance would be due, and I kind of already mentioned that, due to differences between actual price and standard price. I expected to pay $4 for a gallon of milk, and I end up spending $3.50. So I have 50 cents favorable variance. I spent 50 cents less. If I was expecting to spend $4 and spend $5, I have $1 unfavorable variance. I spent too much. Now, quantity variance, difference between actual quantity and standard quantity. Let's say driving to Chicago, I fill out a gas tank and it's costing me about $20 in gas to get to Chicago. However, today I end up spending $25 going to Chicago based on the cost of a gallon of gas. So now I have $5 extra because maybe a number of miles I put in, because there was a detour on the road. So this is money associated with the cost, but I had to drive longer distance and I end up spending more money. I end up putting more miles getting to the same destination. So that's a quantity variance. It's driven by the miles in this case. All right. Standards. So I already mentioned, purchasing manager is responsible for raw materials, so procurement cycle. A lot of organizations have that. And price and production manager is responsible for quantity and raw materials. So you're on a production floor, you're making sure machines are up to par, you're making sure right people are operating the machines, they know how to use the machine and how to arrange the product to align with your standards. Buying and using activities occur in different times. So raw materials purchase may be held in inventory. So we will talk about this. It's very important. Just because you bought something doesn't mean you're going to be using it in production. So if what you bought is what you use, it would be relatively easy calculation. But if what you bought is not what you use, we're going to have some different calculation going on and I'll point this out, so please pay attention to that. Okay, and since I have my LaCroix here, that would be good to drink it. So under each situation for price variances, we're going to do material and labor variance. For sake of this class, we're going to skip variable one. And for quantity variance, we're going to do material and labor. Again, this is tightly related to labor one because we use labor hours. So to make your life a little bit easier, we take this out of this curriculum. All right, I really like this chart. You also have a formula method, which you'll see in the book, but this is a perfect way of doing this. All right, so actual quantity of input at actual price. So AQ times actual price. So actual quantity times actual price. So it's whatever this is general model. So it could be material, it could be actual quantity who worked for me at what I actually paid them for labor. Then actual quantity of input at standard price, because what you paid to somebody and what you actually should have paid could be different. So this creates a price variance. Now, what should be a standard time spent on a job? What should be standard material used on a job? So actual quantity of input times standard price versus actual quantity allowed for actual output at standard price is going to give you quantity variance. Difference between sum of price variance and quantity variance is going to give you spending variance, but difference between actual quantity and actual price and spending quantity and spending price gives you spending variance. When we do material variance, this is only true for spending variance when your actual purchased is what you actually used, all of it. If not, you can just do price and quantity variance. It's going to all make sense, hopefully, as we go through example. But this is awesome model to use, and we're going to keep plugging numbers into this. This is slide 11. I am going to write it down for me this way I can reference back for you guys when we do our exercise. Okay. And I already mentioned that. So standard quantity, actually quantity allowed for actual output of a period, actual price that you actually paid, either employee or for the product. Standard price is the amount that should have been paid for the input. Because we want to compare, when we compare things, it's a good time to mention that we actually comparing a standard, when too much material been used, let's say, and it's not a good thing. So instead of doing 4 cans, we use 3. We want to price the mistake at standard price, not the actual price we paid, because we're mixing one thing with another. Just because you got a good price or you paid too much, we want to price the quantity variance at standard price cost. This way we can separate the issue. So this is very important. The same thing for the labor. All right, without further ado, we're actually going to compute direct material price and quantity variance and look how it's all put together. So here's our Parkers. We're going to make Parkers. So Glacier Peak, and this is something maybe you want to write it down as we go through it, because this example kind of carry through, and we're going to use it for the direct labor as well. Glacier Peak Outfitters has the following direct material standard for the fiber fill of its mountain Parker. So we have 0.1 of a kilo of fiber fill per Parker at $5 per kilo. So that's our standard. Last month, 210 kilos of fiber fill were purchased and used to make 2,000 Parkers. The material cost of total $1,029. Without even doing anything for this chapter, right? Let's say you didn't read anything. If you look at here, 2,000 Parkers are made, right? And 0.1 of a kilo is required. So right there, 2,000 times 0.1. How much kilos we should have used? 2,000 Parkers times 0.1. 200. So you can see right away, right? We used too much fill. I cannot move my mouse. Okay, 210, right? So we used 210. We should have used 200. So right there, without even doing any calculation, you know we used 10 kilos more. So this is kind of where we're going, except it's more structured. We have to look at a price and make sure whatever we paid for it is what we expected to pay. But all we're trying to do and see where the problem is and calculate the variances. Okay, so we're back to that uh, formula that we had. So we're looking at actual quantity. We actually bought 210 at actual price. So we've been given 1,029. So you don't know the price. So you can take 1,029 divided by 210, and we'll know what it is per kilo. So it's gonna been given to us in total, and we can back into this number. So it's 1,029 divided by 210. That's how we got 490. So 1,029. Well, we know that the standard price is 5. So we know we got an awesome price, right? We're saving 10 cents per kilo. So what should you have paid for 210? For 210, you should have paid 5. So it's 1,050, but you paid 1,029. So now you have 21 favorable variance, price variance. You got a good deal on your fill, and it's 21 favorable. Now, let's go to our usage. How did we fit? Did we overfill the parka? Did we not able to use? I mean, there's a lot of questions. Maybe you got a good deal because some of it could have been used and now you're using more of it. So there's other questions. Just because you got something cheaper, and of course, this is something you have to go investigate. Just because you got something for less money, but now in production they're using it more, it could be correlated issues for that. Now, what should you have used? You should have 200 kilos, right? Times $5 per kilo. So you should have spent $1,000 making your Parkers. However, you end up using 210. But do you guys see how we're pricing this at a standard price? And this is very important. We're not giving benefit of that 10 cents of savings into the quantity variance because it's two separate issues, and that's the whole thing. You're trying to separate them. So in this case, you end up spending $50 more than you should have, so that makes it unfavorable variance for material. In this case, whatever you bought, you used in production, and it's all together. So the reason we got 200 kilos, and I mentioned that before, 0.1 times 2,000. And this is mentioned already as well, just more detail. All right, so what if I use a formula? And formula is really the same thing you have on the top here. It's the same thing, it's just in a linear equation. So material price variance is actual quantity times actual price minus actual quantity times standard price. You plug everything in, and you get yourself 21 favorable. So students a lot of times ask, well, how come negative is a favorable? That's just how the formula lays out. So it's kind of in reverse. Positive makes it unfavorable here. And material quantity variance, if you plug everything in, makes it 50 unfavorable. Again, I like the chart part, but this is another source. You have a formula available to you. So who do we go to deal with? We're going to pat the purchasing manager and say, great job, you negotiated 10 cents less per kilo. So material price variance is a purchasing manager. So he gets rewarded. Who is responsible for material quantity variance? The production manager. Production manager are going to be talked to. Why are we using 10 kilos more? And in this case, it's $5 per kilo. What if it's very expensive material and it costs much more? And maybe it's not fitting standards. Maybe people are looking for lighter Parkers and we're overfilling them. It could have other issues. So the standard price is used to compute the quantity variance, so the production manager is not held responsible for purchasing manager performance and vice versa. Okay? The material variants are not always entirely controllable by one person or department. So production manager may schedule production in such a way that require express delivery. So suddenly we're rushing delivery and product costing us more. We cannot go to procurement department and say, you paid more for it, it's your fault, because this is a job that was not put in place. And the same thing for purchasing manager may purchase lower quality raw material, and we suddenly have unfavorable material quantity because we cannot use material in the way it's intended to be used. Now we're going to move to computing direct labor rate and efficiency variance. So we're going to the labor world. The same company, so Glacier Peak Outfitters, has the following direct labor standards for its mountaineer parkers. It takes about 1.2 standard hours per parker, and we're willing to pay $10 per hour for this quality of work or level of work. Last month's employee actually worked 2,500 hours at a total labor cost of $26,250 to make 2,000 parkers. So now we have two things. Are we paying what we're supposed to pay? Because remember, we're pricing a product based on our standard pricing. So if we don't know what it's really costing us, we might not be making money by pricing product incorrectly. So we have the same structure. We take actual hours, 2,500 times 1050 actual rate. So again, we took 26 to 50. This number was given to us. We took 26 to 50 divided by 2,500. So this is actually what happened. And students do ask me sometimes, do I need to break this down? You don't for some questions on the homework, but some you do. So you can just put 26 to 50. I like to see this visually because it really brings it concept and you understand how numbers tie together. Actual hours 2,500, but you should have paid them $10 per hour. So you're paying 50 cents more. Therefore, we have 1,250 unfavorable variance in this case. Now, we are paying a little bit more. Maybe we're getting super duper employees who are super trained and they're demanding more money. Let's see how well the efficiency work. So 2,500. So if I go back to my problem, I have 2,000 parkers, 1.2 standard hours. So if I take 1.2 times 2,000, I should spend 2,400 hours to make 2,000 parkers. And I'm expecting to pay $10 per hour. But I have people working extra 500 hours. So now I'm pricing my efficiency at standard cost. I'm not pricing it at actual one. So I should have paid 24,000, but I paid 25,000. So my efficiency variance also unfavorable. So in this case, my spending variance is combination of those two, 2,250. However, if you look in here, right, my efficiency can be priced separately from rate variance. So for rate variance, I'm going to go and talk to my HR department, find out why we're paying more. Maybe there's new law regulations of his labor rights and so on that requires to pay more for certain jobs. And then for efficiency, I have to go talk to the shop floor supervisor. Maybe machines were not ready. Maybe maintenance not done and takes people longer to do things that they would do automated. Now they're doing manually. There could be a lot of reasons. It could be not necessarily employees' fault, but at least you can separate and price the problem. Okay. So this is our Parker cost again, and this is how we figure out per hour rate we actually paid. And if you put this in equation format, it's the same thing we did before. You can calculate the same thing. Again, if you come up with a positive number, you become more unfavorable. And if it's a negative, it's favorable. But you can also step back and say, okay, I should pay them 10. I paid them 10.50. You already see where the number is at. All right. Responsibility for labor is a mix, and I mentioned that already before. Mix of skills level assigned to work tasks, to assign right people. Level of employee motivation. What are we doing to keep people motivated? Are we rotating them from task to task? Are they too stagnated being in the same job or in the same task, especially if it's repetitive manufacturing job? Is quality of production supervision is good? Is somebody there to make sure they are doing right thing in the right time? Maybe they don't have enough guidance. And training provided. So there's a lot of things that can be involved and results of those variances being where they're at. Labor variances are not always entirely controllable by one person and department. I mentioned maintenance. If a machine is broken, somebody might not be able to do their job, and suddenly they're clocking hours and it's going towards the job. So unfortunately, unfavorable labor efficiency variance might be reflected not because employee is not able to do their job. And the purchasing manager may purchase lower quality raw material again, and employee have to, going back to my sheet here, employee fiddling around to fit the four things because the clamps would not sit on because the edge is too thin, because the quality of material is not great. So those things need to be considered, and all sides of the story hopefully should have been heard. But at least you can price the problem and put them into different areas. The quantity variance is computed only on a quantity used, and the price variance is computed only entirely on quantity purchased. So this is the one that I mentioned to you. So it's very easy problem when it's both the same, but when it's not, it becomes a little bit more complicated, and we're going to look at one of those in a second. We're going to look at the same problem. So we have a glacier picket fitter has the following direct materials: 0.1 for kilo per fiber, $5 per kilo. Last month we have 210 kilos of fiber were purchased at cost. Glacier used 200 kilos to make 2,000 power cars. So remember, in the last one we used all 210, but in this case we used 200. So 10 is still sitting on our inventory. So we cannot use that for efficiency variance because we did not use it. So what happens in those situations, and we'll have a chance when I go through another example to see this again. This variance right here, price variance, is the same. We have to look what we bought and what we should have bought, what price is at. So it's $21 favorable. However, when we're looking at actual quantity used, we cannot use what we purchased. We have to only look at amount that we put in production and compare this to what it should have been used. So in this case, the actual quantity used is 200, and we should have used 200. Therefore, my quantity variance here is 0. So when my material variance purchased does not equal used, you're going to find this middle part, you will have to recalculate it. Those two are different because actual quantity purchased is different than actual quantity used. So this is very important. This is my slide 34 that I might have to refer you guys back to. Okay, let's talk about advantages of standard costing. I already mentioned it right in the beginning. Standard costs are key elements of management by exception approach, so they can see it right away. Reports can be run relatively quickly. Standards can provide benchmarking that promote economy and efficiency, so I can actually look at employee performance per department, per shift, different plans, compare different plans, different stores. Standards can greatly simplify bookkeeping too, and can support responsibility of accounting system. And you can actually work through different departments and encourage them. People know you're looking at the numbers to do better. Potential problems. Sometimes you might be pinpoint problems in the wrong direction, and there's a lot of dancing going on to make sure you don't hurt anybody's feelings. So standard cost variance report are usually prepared on monthly basis and may contain information that is outdated. So if it's monthly, maybe you already bought a product and you say, you know what, that was a one-time deal. The product was so cheap. This is no longer relevant or no longer applies going forward. If variants are misused as a club of negativity, it reinforces employees' morale may suffer. So you cannot say, okay, got to do 1.2 per hour, 1.2 per hour. You're not meeting your goals. You're not meeting your goals. That could be a problem. And labor variances assume that the production process is labor priced and labor is variable cost. Those assumptions are often invalid in today's automated manufacturing environment. So that's something to remember. All right. Just meeting standards might not be sufficient too. Continuous improvement might need to be done and reevaluated. In some cases, a favorable variance can be as bad or worse than unfavorable variance because you would put a new standard in place that cannot be met by others. Excessive emphasis on meeting standards may overshadow other important objectives such as maintaining and improving quality, on time delivery, and customer satisfaction. So just to get a favorable at cost of other departments might not be the best solution. Okay, so this is the end of the concepts and the big picture. And what I want to do next, I want to jump into this example I created. And I manipulated a little bit one from the book, so a little bit different numbers. So what we have here, and this is a data here, we have a problem with direct material of standards, we need a 3 pounds, 3 pounds per product. I don't know, what should we make? Don't want to make a bike. Let's make a bike. Okay, let's make bikes. Okay, so let's say I needed 3 pounds of metal. There's all this stuff the bikes are made of right now. Some are very expensive. So 3 pounds, and then a standard price, that would not be a price of metal. Okay, maybe that's not the best example. $4 per pound. And then direct labor, it takes about half an hour, right? And we're paying $20 per hour. So we improving with this example employee rights here. And we went from example of $10 per hour to $22 per hour. So our actual output is 2,100 units. Our actual direct material cost, we bought 6,350 pounds, and we paid $4.10. So before even I'm doing anything here, right? Before I'm doing anything here, I can see that I paid more, right, than I should have paid. Actual direct labor cost 1,020 actual hours, and I paid 22.10. Again, right there, right? You guys can see that I'm paying more per hour than I should. Let's see, maybe they're more efficient. Okay, so the first example, or the first thing we need to do, we actually have to calculate our material variances. So we're going to take so I'm going to do all my calculations, and then we're going to go to material price variance, material quantity variance, and spending variances overall. So actual input at actual price. So we have our actual input. Well, and I already had the price here. I did not delete that from my example. At actual price, so this is my actual price. So this is this would be my actual quantity of input at actual price. Now, actual quantity, again, the same number, but I should have paid only $4. I'm going to copy my formula. So this is 63.50 times 4 is 25.40. So I'm going to just stop here. We'll just do the price variance. So my absolute value of this minus this. So I have 635. So my absolute value of material price variance is 635. And we know that's unfavorable already, but you can see also, right, that if you take this, what you should have had, minus what you did, it would be negative number, which would make it 26,035 minus 25,400 would make it positive number, which make it unfavorable. But you can even see it from here because you pay 10 cents more. So all I did, I took a difference between two to find out that I have $635 of material price variance. So I paid $635 more. Now let's look at the standard quantity allowed for actual output. I made 2,100 units, and I should have, still like that bike idea, but I don't think you can pay $4 per metal. Maybe it's kids' bikes. Okay, a little kid bike. Times direct material. So what I should have done, besides hitting enter too early, I should have used 6,300 only, and I have to price this at a standard price. So at standard price, I should have only spent 2,500, 25,200 on my producing my bikes here. So I'm gonna do absolute value again. This. And that's 200, and again unfavorable because I spent 50 pounds more. Now, if I add those two guys together, in this case, well, actually the best thing would be to do, and you can only do this when you used what you bought. It happened to be total between 835. So you can have one favorable, one unfavorable. So obviously this number is not always plus two variances. But you can only do the spending variance when pounds purchased, right? Pounds purchased is a number of pounds actually used. So that's an example of when we have material used the same as what we purchased. Now, to extrapolate this, before I go to the labor variance, on this sheet right here, I created another example. Actually, there we go. Okay, so here, what I did, I took the same example. However, we're going to do this a little bit differently. I don't think I can fly with this like that. All right, so this is the same problem we just did. Direct material, $3. I took labor out. We're going to go back to that. Actual output, 2,000. But in this one, I'm giving you additional information. I'm telling you that actual direct material used is only 6,000. So I bought 6,350, but I only used 6,000. So how does it look different? So this is the goal of this exercise. So for this one, and this is actually, if I would go back to my slides here, that was slide 34. I'm trying to do this. This middle part, we're going to actually recalculate. So we just did the purchased is the same, but used is different. So we're going to actually go in that mode. Okay, so 6,350 actual quantity purchased, right? And this is actual standard price, which is $4. So I'm going to go back here. I'm doing the same thing I did before. This times my cost per pound. I can copy this. This is true. So this would be the same. So if I'm going to do my material price variance, it's going to be the same. I just want to make sure I show you guys this to ensure that you can do this. Okay, 635. And yes, it's still unfavorable. Okay, but material quantity variance, I cannot use 635 because actual quantity of input is only 6,000. This is actual direct material used. So I have to use that number. I have to use actual direct material used, not 63. So now I'm going to use what I used in production. I still have to use a standard price, so that did not change. And that changed what my actual quantity of input at a standard price. Now, my standard quantity, I did not change anything else. What I should have used for 21,000 units is this times 3 per pound. So I should have used 63. And again, I'm going to price this at a standard price. And now you can see I used 6,000 and I should have used 6,300. Plus, I really wanted to have one positive one. This. And you got it, guys. This is a favorable one. So I used 300 pounds less, and I priced that at $4 at standard price, not a price I bought it at. So when we have material actually purchased versus used, we do have to calculate this middle part twice. Okay, so I hope that got my point across. All right. Let's go back to our example. And we're going to talk about, jump down here, our labor. So for direct labor, we have to use half an hour, and we pay $22 per hour. So in this way, we have actual hours of input. They're telling me that the employees work 1,020 hours, and our actual rate is we paid them $22.10. So this times this. And again, if you need to stop the video, I would recommend even like writing this out, get your calculator going, and make sure you can back into those numbers. Maybe after you're done watching the video, just pause it and redo the problem without looking at the answers. I think it's a great way of practicing. It's a great way of practicing before you approach your homework. Now, the second part, we have actual hours of input. So we have our actual hours. And we need to look at a standard rate. We should have really paid only $22, 10 cents difference, but it could be more. We have to be doing a job. We did not come up with standards, we're just calculating. So right here, we can calculate labor rate variance. We can calculate labor rate variance. So and it is unfavorable because we pay 10 cents more, and this minus this would be obviously a difference. What should we spend on this job? Well, we made 2,100 units, and we should have just taken half an hour. So we should have spent 1,050, and we have to price this at standard rate. So with that, we have 23,100, but we spent 22,440. So here we actually have a favorable variance. We spent less. We spent 30 hours less. Maybe we paid extra money. They were very qualified employees. So we're going to look at absolute value between this and this. So the reason we do absolute value, because we, instead of saying plus or minus, we're saying favorable and unfavorable. That determines if it's negative or positive. This way people don't see it, because you actually come up with a negative to get a favorable, and you come up with a positive to get unfavorable. So this gives indication to people you're talking to, management, if it's a good thing or not good thing. That's why we're taking absolute value. And here we're going to take the difference between 2, and overall it happens to be favorable. I already pre-entered this. Obviously, you will determine this based on your calculation. And we had more favorable, so it takes over unfavorable one, and we had some extra. So nutshell, this is our calculation. This is a great example to look through it and maybe redo. You have it right in front of you. And I am going to go back to my recording. And this is variance analysis. Again, overhead is also part of the chapter. It's closely allocated to the labor variances. So with overhead, if I would extrapolate that and continue, what would actually happen? It would end up being favorable and unfavorable exactly as the labor variance was, because it's connected to that. So it's not exactly always a good representation of how you're spending your money. It's more representation of how labor allocation is happening. That concludes the chapter. Good luck. I'm here for you to help you if you need any help. Thank you.